Hey guys, all right, we are on the last major category on the balance sheet. It's called equity. I think this is really the most important number. I think it's more important than net profit on your income statement, which we'll cover in another series. We'll do that soon. But this number really is a very big indicator of what your business is worth. And isn't that really why we're in business in the first place? Is to create something. One mistake I feel like I see a lot with small business owners is that they don't realize that they're building an asset that can actually be sold. I've seen way too many of them just, I'm done with my business, I'm gonna retire, and they just close the business. Why don't we, the whole reason for all of this is to prepare for an exit, a day where we eventually get to sell the business and have something of value that we can pass on to somebody else in exchange for dollars, right? So the last section is equity. So before we get to that part though, let's just do a little bit of a recap of where we have gone so far. We've covered current assets. We've covered current liabilities. We've covered non-current assets. We've covered non-current liabilities. And you know what? I'm going to include the total liabilities in there too. Okay? So that leaves us with our equity section down here. Okay? Let's get all that off there for a second. And this is the section we're looking at right now, the total equity section. And there are basically 4 different things that affect this. And we'll talk more about this when we do yet another financial statement called the statement of cash flows, but I'm going to briefly touch on it here. There are 4 ways that this goes up or down, okay? The first one, and the one that happens literally every month, whether you like it or not, it's happening. And that's either net income up, your equity goes up, or net loss, your income or your net equity goes, your equity goes down. All right. So net income or loss, and that is going to be coming out right here in your retained earnings. Okay. Retained earnings is where that lives. The other one is going to be, there's another one called owner's capital, okay? Owner's capital is basically monies invested in the business from the outside, okay? You've put money into the business to get this thing going, and there, it sits there. A lot of times what some small business owners will do, or any business owners, it doesn't have to be small business owners, but business owners will do, is they will put funds in, and when the business is doing well enough to pay them back, they get a return of capital, and that owner's capital account may go to zero. And then eventually you're getting basically distributions out of the retained earnings account, which is the other 2 ways that the equity balances go up and down. And that is, I mentioned them, but let's talk about them a little bit more detail, is contributions. That's money coming into the business. That makes equity go up. And then there is a distribution that makes equity go down. Okay? So that is the balance sheet in a nutshell. Okay? We've gone through everything. We have gone over current assets and current liabilities. We've gone through non-current assets and non-current liabilities. And, well, obviously we've gone over total liabilities as well. And finally, we've gone over equity. Now, let's just, before we talk about what's coming next, I want to just point something out, right? So going back to our equation, it's a little bit more complicated, the addition, but that's all that it is. It's addition and that's it. It's basically addition and a little bit of subtraction. And here's assets, right? Plus, remember our equation? Assets equals liabilities plus total equity. And total equity and total liabilities and equity equals our total assets. Okay? So like I said, it's simple math, not really a big deal. And then tomorrow's video, what we're going to talk about is, so I'll tell you what, going back, taking a small step back here, the accordion now has been fully expanded. We've talked about all of the various areas as high level as what an asset is to as low level as what cash might be or total liabilities might be. We've gone down into the granular. Okay, so we've covered all of that now. So the accordion has been fully expanded, but there's another way that we can expand this, and that's what we're going to start talking about tomorrow. And that is when it comes to time. Now, one thing I don't think I've done a very good job of talking about on the balance sheet is that this is a snapshot in time. I know in the previous series I talked about this at length, but it is like, think of it this way. It's the difference between taking a picture and taking a video. Think about a sporting event, right? It could be the iconic picture of Jordan jumping up when he wins his championship or something like that. But what about the video of that very same event, right? That's the difference, right? So the balance sheet is a snapshot in time where the income statement and cash flow statements are videos, right? It's over a period of time. Okay, we'll talk about that more later, but we're gonna expand the accordion time-wise on the next video. As usual, please comment if you have questions. And if there's anything that you want me to cover in a later video, let me know. And as always, follow our page. Thank you. We'll talk to you guys tomorrow.